morning, Christopher.
Good morning.
Welcome to the Stavis Legacy Lounge. We are so honored to have you here, and I need to tell the audience a little bit about you, although most people probably know you. Christopher is the founder, chairman, and chief investment officer of CAZ Investments, which began in Houston in 2001. With over 30 years in private equity, private credit, and public markets, you have really led the future of really incredibly interesting alternatives. And your accomplishments earned you the award from the Texas Alternatives Investment Association as a Lifetime Achievement Member. Congratulations on that.
Thank you.
And you've been a major contributor to media outlets, CNBC, Bloomberg, Fox, and your contributions charitably to adults with autism, as well as the Children's Fund, really distinguish you. And we are so thrilled that you join us in the Legacy Lounge, especially coming off of the book you recently co-authored with Tony Robbins, The Holy Grail of Investing, which became a New York Times #1 bestseller. With lots of credits to your name, welcome.
Well, thank you so much. It's fun to be here, and I appreciate the time.
Thank you, Christopher. With that whole world of private investments, private credit, real estate, private equity, could you tell us what the major buckets are if someone is just approaching this for the first time and maybe concerned with the public markets today? Exactly what kind of buckets you could be looking at in investing?
People get really overwhelmed by the private markets because they have a hard time trying to understand what it means. And people hear the word alternative investments, and they're like, oh, I don't know what that is. It sounds risky. Every single person that's ever owned a home owns an alternative investment. It's a real estate investment that they have made. They cannot sell it every single day, and it doesn't mark to market every single day. So it's really no more complicated than that. People are very comfortable and familiar with a home that they own, but then they start thinking about private businesses or private credit, and they get a little overwhelmed. So to answer your question the best I can, the major buckets really are private equity, which would where you're an owner of something that's a private asset. That can range, it's kind of like saying a mutual fund. A mutual fund can be anything. You can have venture capital, which would be early stage companies, usually technology, but could be biotechnology or other types of businesses that are very early. You have growth type investments, which are a little bit more mature, but have not necessarily hit escape velocity yet, if you will. And then you have buyout, which is going to be more mature companies typically that are being bought for whatever reason at that stage in their life cycle. That would be buyout. Then what you have is the private credit world, which is effectively loaning money to private assets, private companies, could even be sometimes public companies, but private credit meaning it doesn't trade on an exchange. And that is really the two big buckets that are there. And there is 1,000 ways to slice it inside of each of those buckets, but effectively you're either an owner or you're a lender in something that you cannot sell every single day. It doesn't trade on an exchange. That's the simplest way for somebody to think about it. And then from there, they can learn a lot more.
So it's equity or fixed income, and you can pick your flavor. The thing that does concern some people is the fact that it doesn't trade on the public market every day, and so there's that lack of liquidity. Why would someone go to alternatives if they could trade on the public markets?
If they were an apple to an apple, there's no reason to give up liquidity at all. The reason why somebody would be willing to take less liquidity or illiquidity would be because they're going to get paid more, or they're going to get some better diversification as a result of owning those types of assets. If somebody literally can trade something every single day and get the exact same return with the exact same risk, then stay there, do that. But if they're looking for something that is not going to have the same correlation, it's not going to move at the same time in the same direction, then the private markets are the only place really to do that. The other thing is that the vast majority of the economy is actually in the private markets, not the public markets. There's some amazing companies in the public markets. The large one that everybody knows, the NVIDIAs and the Amazons and the Apples and the Walmarts, all of those are in the public market. but actually 87% of all the companies in the United States that do more than 100 million in revenue, they are in the private market only. They don't trade on a public exchange. So people are missing out on enormous opportunities if they completely just do one. Now, every family's got to look at it differently. Some can have a lot of liquidity that they need to stay very, very liquid. Others don't. It's all part of the planning where firms like yours can really give good counsel as to what somebody should be looking at. But to give you some perspective, over the last 35 plus years, private equity has outperformed public markets by over 500 basis points a year, 5 percentage points a year, compounded annually. That is an enormous wealth difference for someone that has the ability to accept less liquidity.
And it's perfect for that was a great explanation, by the way, and for multi-generational planning, where one is passing through and the keeper of the family's estate, it can become a really important part of a portfolio allocation.
Absolutely. It's something to where we have investors that are, work with advisors like yours that are, 89 years old, and they buy a fund that doesn't have liquidity for a decade. And somebody says, you're very optimistic. And the answer is it's actually not for them. It's for the next generation. It's for the wealth planning that they want to do, the potential charitable giving that they want to do. Ultimately, where is the best place to allocate capital and be the best steward of the gifts that we've been given?
That is an exceptional foray. So you mentioned correlation, and there's a lot to be said about that. Can you talk a little bit about correlation and negative correlation?
So one of the things that we really focused on in the book that I wrote with Tony is, the Holy Grail of investing is all about, what most people in the industry refer to as modern portfolio theory. Markowitz won the Nobel Prize for proving that if you have assets that don't move in the same direction at the same time, you can actually reduce your risk and increase your return. And most people go, that doesn't make sense. How can you reduce risk and increase the return at the same time? Well, that's why he won the Nobel Prize, because he proved that. Ray Dalio has made this much more understandable for people by calling it the Holy Grail of investing. And it's a little bit of a tip of the hat to Ray and the incredible accomplishments that he has done. But effectively, most people in the public markets, public credit, public equity, they have so much more correlation than they realize. I gave a talk about a week and a half ago, and somebody in the room said, well, I'm diversified. I own Amazon, I own Netflix, I own Meta now, I own NVIDIA. So I'm diversified. I'm like, I don't think so. Let's maybe talk about the correlation. What I use, I'm a golfer, so it's easier for me to use analogies that are comfortable for me. If somebody had a golf shop and they only stocked rain gear, that's all they sold in their entire golf shop. On rainy days, they're going to sell a lot of rain gear. Right. On sunny days, they're going to sell very little rain gear. Just the same, if all they sold was sunscreen, on rainy days, they're not going to sell much sunscreen, but on sunny days, they're going to sell a lot of sunscreen. If you have in your shop both, well, then one is going to do well at different times than the other. That is negative correlation, to answer your question, when things are literally moving in the opposite direction. Everything else, for the most part, has somewhat correlation. If you have rain gear and you have umbrellas, they're not always going to sell at the same rate at the same time, but they're going to be somewhat correlated as to when they sell. The more diverse your retail practice in your golf shop, the more smooth your ride is. Hopefully your revenue is more consistent and your profits are more consistent. And people don't think about that in their investment portfolio. If everything's always winning or losing at the same time, that's a bumpy roller coaster. If everything is moving at different times in different directions and you're diversified, it smooths out that roller coaster. And for most people, not everybody, but for most people, if you can end up in the same destination and have a smoother ride to get there, that feels a lot more comfortable.
We've been noticing that correlations across the board are breaking down. Wonder what your thoughts are, because you did mention correlation, and even the correlation between stocks and bonds, the correlation between small cap, mid cap, and large cap US. What are your thoughts there?
It has become a very correlated world, and part of the reason for that is because so much of the world is now indexed. So when we think about index funds, their job is really simple: to own the index, period. So whenever money comes in, they have to buy more of that index. If money goes out, they have to sell some of that index. It is not a decision of what to sell, it is mathematical, which means if the markets get a little wonky and everybody's leaving the building at the same time, those managers don't have a choice. They literally come in the door, say, this is how much you have to sell today. And then if the markets get good and excited, then they come in and they say, this is how much you have to buy today. That's it. So it's causing correlations to get more and more in sync across multiple asset classes. The one that's really interesting is that for a long time, bonds were the perfect diversifier against stocks, thus the 60-40 index.
That's the expectation
That's right.
of investors.
The last decade, the correlation between stocks and bonds is the highest it's ever been. Literally, it is 87% correlation, which means 87% of the movements are basically in sync. Now, the last month or two, that's begun to change a little bit, where bonds have been rallying because of concerns about what's going on in the overall macroeconomic environment, and stocks have been selling off. So some of the traditional correlations have come back a little bit. We expect, however, because of the indexing of the world, and particularly in an inflationary environment, which we think we're going to be in for a while, we think those correlations are going to continue to be very high, which means in order to get the holy grail of investing, in order to get the diversified approach, which is 8 to 15 less correlated assets, people have to go to the private markets in order to accomplish that objective. There's no other place.
That's really good thinking. And, you know, from our standpoint, whether you're in cap weighted or equal weighted, the stats vary, but anywhere from 30 cents of every dollar is going into direct indexing right now. So what do you have any idea about that outcome? What does that spell for us on a look forward?
It spells more volatility. It spells a situation to where the markets are truly going to be driven by money flows as opposed to security selection. Because in whether it's direct indexing or regular indexing, the job is just to track the index. Therefore, when money comes in, they're a buyer. When money comes out, they're a seller. And that means the more money that is in indexing, the more it's a one-way street.
Absolutely.
We have a preferred stock manager as an example. All they do is take advantage of mispricings between preferred stocks. And what they saw during 2022, when the market was just basically really getting hammered, is that there was no buyers of any kind, because all of the index funds and the ETFs that focus on preferred stocks, they literally were just selling every single day, and there was nobody on the buy side. It created enormous opportunities for them because they're the only buyers in the room. And that obviously means you have a pretty good ability to set price. So when you see the markets get very lopsided, when you see this large increase in indexing and ETFs fit in the same category, it is something to where most of the money is not thinking about whether or not this is a good time or a bad time. It just doesn't have a choice. It has to be a seller or it has to be a buyer.
And it just flows. And so, it can trigger all kinds of things. I mean, can you imagine a scenario where we really see, significant disruption?
Well, it's always scary, because anytime we try to predict the behavior of humans, it's tough. So when we look at, events in the world, small events, big events, whatever they are, individuals effectively drive flows. When individuals drive flows, then that means that the markets are going to get very volatile, and they're going to get, I think, more volatile going forward than they have been in the past. It doesn't mean indexing is bad, and it doesn't mean direct indexing is bad. It just means that the side effect is that you have more and more money that is not thinking about timing. It is strictly looking at in or out, and that creates volatility.
And it's usually been extremes that result in the forward problems.
That's right. That's right.
We may be in a similar situation.
Well,
right
it's
now
where we
in
are
this case.
today. And I one of my favorite quotes that I use all the time is that stocks always go down faster than they go up, because fear is a much stronger motivator than greed. And greed's a pretty strong motivator. And so some years like 2021, everybody's just thinking the world's going to go to the moon and everything's great.
Right.
And then 2022, everybody's like, oh my gosh, this is tough. Interest rates are actually going up again, as though that's never happened. But so when that occurs, the volatility becomes extreme. And when the volatility becomes extreme on the downside, it becomes really hard for people to stick with their plan because they just see the velocity of the decline is so extreme.
And you can't insulate an investor from that entirely with private equity either. But what are the advantages in an uncertain market?
You're right. There is no free lunch in this world. And so the advantage of the private markets, and I go back to somebody's home as an example. Somebody's home in 2008 went down a lot in value, depending on where they were in the world, most homes. But they didn't see it in the Wall Street Journal every day. Your home lost 5% today, it lost 6% today, it lost 2% today. So because of that, people are less panicked about the decline in their home value. If they tried to sell it, they were feeling it. But if they weren't a seller, they didn't have to worry about it. In the public markets, you got to look at it all the time. It's on every single device that we have in our hands every single day.
It's a daily reminder.
It's a daily reminder versus in the private markets, if somebody owns a piece of real estate or they own a private company or they've made a loan to a private company, it doesn't get mark to market every single day. So it may be impaired or it may be affected by what's going on in the world, but they don't have to worry about that psychology that comes with, oh my word, today I'm down, tomorrow I'm down, the next day I'm down. That allows people to have a longer term view. And because of the fact that the public markets adjust so much more dramatic than the private markets, they just don't have the volatility in the private markets. A really good example would be the average public company might range 30% in a period of a year. If the entrepreneurs that are watching this think about their business, unless it's growing really dramatically or suffering really bad pain, it doesn't change in value by 30% in a year. It does change, but hopefully it's more predictable. That's the ride that investors can expect in the private markets.
Yeah, I mean, behavioral investing allows people to make knee-jerk reactions because they can trade daily. So that does make a lot of sense. Considering your focused approach, how do you determine, what strategies to offer different investors?
I'll answer it two ways. The first is that we're a thematic investor. We look for a theme, something that we believe is going to persist for a reasonable period of time, think 3 to 10 years or longer. And then we're going to find the best risk-reward way to take advantage of that theme. And then we're going to find the right partners, the right opportunities to be able to take advantage of that theme, to profit from that theme. A good example is always, helpful. So in 2007, we believed that the housing bubble was going to burst. We had very strong conviction of that, and we had no idea how to short a house. But I had a long relationship with a gentleman by the name of John Paulson. He had come up with a way to actually short subprime mortgages, and as a result, we were able to partner with him, invest our capital and that of our network to be able to take advantage of what was the bubble bursting, which provided a lot of profit for us, but also a lot of protection for us because it was totally negatively correlated, going back to earlier, negatively correlated to everything else that people had in their portfolios. And that's the second part of the answer, which is every single day, our firm does nothing but think about where we're going to invest our own personal capital. And then from there, we're going to make it available to everybody in our network. So we've got about $650 million of our own capital invested in our own vehicles.
Amazing.
So my family's money, our firm's balance sheet, our shareholders' capital, our team's capital, we are the first money in everything we do. So then our network has the ability to do whatever it is that we're doing. So thematically, we select, then we choose to allocate, and then we open it up to the ecosystem.
We're definitely going to want to hear about what you think the thematic investment of the day is. What are some of the ideas that you're really excited about?
So the great thing about thematic investing is it's really something that persists over time if you get the themes right. So as an example, right now, our kind of 4 core themes, and we have some others around that I'll comment on, but our 4 biggest themes today are the growth of private assets. Reason we're having this conversation and talking about private assets is that more and more investors realize the benefits that private investing will deliver for their portfolio. We believe that is going to persist. So that's the first theme, and I'll tell you how in just a second how we're taking advantage of the theme. The second theme would be the reality of cord cutting, which is the change in consumer behavior of people moving away from broadcast and cable to streaming services. I think every single person would agree the private markets are growing and that people are moving away and cutting the cord and moving to streaming services. Mm-hmm. The third is that the need for energy is accelerating at a very, very rapid rate. And so we believe very strongly that there's going to be more and more need for energy, and there's a unique displacement of price that has occurred there, supply and demand, that I can comment on. And then the fourth that we feel very, very strongly about is that there's a need in the world of liquidity for people in the private markets. Some investors have invested in the private markets going, of course I'm fine with not having liquidity, until they're not fine with not having liquidity. So we believe there's a very significant opportunity to provide capital to those people to help them accomplish their goals and objectives without them having to liquidate and sell those positions.
So establishing a secondary market, if you will.
Establishing a secondary market or even a lending market, a private credit opportunity, alternative for people to where they can borrow against those positions instead of just having to sell them potentially at a very unattractive price.
Very flexible.
That's right.
That's brilliant.
And each of those four themes, and again, there are more. Healthcare for an aging demographic. Nobody ever thought about that one yet. Disruptive technology. Nobody ever thought about disruptive technology. All of those are major themes of ours that we will then find the best risk reward way in each of those themes. In the case of the growth of private markets, we want to own the firms themselves that are going to get paid to manage all that money.
Incredible.
In the world of cord cutting, we want to own the organizations and the content providers that are going to benefit from providing content that is only available in a live format. Sports is what that is. And then in the case of energy, we're all in on energy. We'll do everything in energy. There's no limit to what we'll do. Our saying is we're for all energy and we're against all poverty. So we are doing everything in energy that is available to us. And then the credit solution we already talked about.
Let's talk about energy and AI. I don't think anyone fathomed the amount of energy that it took. And now it seems to be bringing some of the tech and the energy companies together in a way that they haven't normally played together as well.
They tend not to be as aligned as they are today. So everybody has the same challenge, though. Whether we want to turn on our iPhone or we want to put heat or electricity for the air conditioning in our homes, it takes a lot of energy. And unfortunately, because of reasons that are totally understandable, people have started not investing as much capital in finding new sources of energy. Well, that's an understandable position, but it creates an imbalance. So here's a statistic that should terrify everyone who's watching this. In the last 5 years, for every 6 barrels of oil that we have consumed, produced out of the ground, we have found 1. 6 that we've used, 1 that we've replaced.
Discovered.
For those that are more understanding of the energy world, we call that the reserve replacement ratio. That reserve replacement ratio for the last 80 plus years has been effectively 1. For every 1 barrel you produce, 1 barrel you find. And that's what creates equilibrium. The last time we had anywhere close to this kind of an imbalance was basically the 2010s, which led to crude oil going to $140 a barrel. So that doesn't mean that's going to happen this time, but supply demand still matters. And if we do not find more sources of energy, we're going to not have as much as we need, which is going to be a supply shock, which is going to create price significant dislocation. And anyone who lives in Europe that might be watching this, they know exactly what happened when Russia invaded Ukraine, and all of a sudden the natural gas was not available, and their cost of natural gas went up by 10-fold. Again, I'm not saying that's going to happen in crude oil, but it's possible if you just don't continue to find new sources and produce as much as you use. In the book, it was a fun analogy. I hear more about this analogy than anything else related to the book. We talked about anybody who's ever had a teenager and you have a gallon of milk. if at the beginning of the day the milk gallon is full, by the end of the day it's not likely to be full. Well, if you don't go to the store and buy more milk, you're going to run out. And people go, oh, of course that's true. Well, but nobody thinks about that with energy. If you use it all and you don't find more of it, you're going to run out, or at least you're not going to have as much as you need. So we are for all energy. We're for solar, we're for wind, we're for every source that can be out there.
Anything that can draw
But
power.
the most reliable, the most responsibly sourced, the most predictable, and the least expensive is what ultimately is going to generate investment returns. So for us, we're invested everywhere. Nuclear is really the solution to this. And it's starting to get a lot more momentum, but it's so long before it actually happens. There was just a permit set up in Texas to be able to do this. And everybody was really excited about this for a new what's called small modular reactor to where you could maybe power a whole city just with one reactor that's close. It's very safe. They expect to maybe come online in 8 to 10 years.
It takes time.
Takes a
and
lot of
we've
time.
done a lot to discourage that kind of adventuresome wildcatting and the development that made the energy industry
But that's
great.
where your comment about technology is fascinating, because of the fact that that is the solution. Is we will find solutions to this need, but it's going to require a favorable environment from the ability to do what needs to be done, but it's going to take new technology innovations in order to be able to accomplish it faster, better, smarter, cheaper. That is where AI will be very helpful. It's obviously a big consumer of energy, but it'll also be part of the solution.
Very informative. And you've made headway in the housing market in a very unique way. Can you talk about the 3D printing?
Sure. So there's a company in Austin by the name of Icon. Icon was the first to basically print a home with a 3D printer. And at that point in time, everybody's like, what in the world is that? The best thing to do is to go to YouTube or go to the internet and just say Icon 3D printed home. And what you'll see is a printer that just, for those of us old enough to remember a dot matrix printer, it's the exact same thing. It just goes back and it goes forth and it goes back. But what comes out, it looks like a tube of toothpaste. It's concrete. So they can print a home infinitely faster than traditional construction. Right now, less expensive than traditional construction, and in a much more sustainable way because of the materials that are involved. And it can run literally 24/7 because it is a printer that can be operated by a single individual. You can have them work in 3 8-hour shifts and it never has to stop. So it's gone from concept to very much reality. Lennar Homes partnered with Icon to print an entire neighborhood outside of Austin. They just announced 2 weeks ago, I believe, that they're about to do another one. The Department of Defense has printed large barrack with it, and NASA has actually engaged with the company to understand how a printer like this might be able to be used in space stations or exploration to the moon or wherever it might be. So the science behind it is breathtaking, but it gets down to this very simple concept of housing's been done the same way for basically
So long.
ever.
Right.
It has not really changed. There's been no innovation. And it's incredibly labor intensive and takes an enormous amount of time. So Jason Ballard, who's the founder of Icon, he's so passionate about fixing the global housing shortage, the homelessness issue, to be able to help folks that have been affected by disasters. And the printer was the fastest and least expensive way to accomplish that. And we're so proud of the company. We were seed investors in the company, and we've been supporters of theirs the entire path of their growth.
Well, it was so inspiring to hear him say that even though it's a bold goal, he thought that eliminating homelessness could be achieved. It really made sense.
It can be done, and they've already started because they partnered with several charities that their objective is to take people off of the street, primarily in Austin, but they've done some things in Mexico and some of the other places that are just really impoverished. And this is not the Taj Mahal that they're going to live in. But if it's 400 square feet, 500 square feet, it's clean, it's protected from the elements, and it's someplace that they can go and they know they're going to be safe and they're going to be cared for, that's a real strong possibility.
And there's evidence that it could withstand earthquakes and other problems even better than the traditional homes.
Very much so, because it's rated to a higher level because it is just concrete. Imagine, in the islands of the Caribbean, they build homes out of cinder block. It's no different than that.
Right.
To withstand the winds. The roof might fly off, but the home will still be standing. It's a lot easier to put a roof back on than to rebuild the whole thing.
Yep.
So when we invested in the company, it very much fit the classic statement of doing well while doing good. And we really believe that we were going to make significant amounts of money, but we're also going to be able to make a difference in the world.
Terrific. And you were early to the party on sports investing. Mm-hmm. Exciting. Can you speak to that?
It's funny. If you ask our partners in that, they'll say we were very slow to the party because we spent about 18 months in our due diligence there. So they would have liked us to act a lot faster. But in our case, we recognize the theme of the change of consumer behavior. We recognize that cord cutting was not going to go back the other direction. And the problem for most advertisers is they don't really have the ability to reach their audiences the same way they used to. You think about the old days as in 10 years ago, the old days, you would just literally go to whatever the most popular program is on TV, you'd buy an ad there, and millions of people would watch it, and hopefully they would buy your product. Well, you can't do that now because Netflix and Amazon Prime and Apple TV, you cannot reach them that way.
Absolutely.
So you have to go to live events. So in 2005, sports were 13 of the top 100 watched live programs. 13. In 2024, 97 of the top live events, watched programs, were sports.
Astounding.
It is truly a seismic shift in the way that consumers are absorbing content. Well, if you are only going to watch a commercial, if it's a live event, then the people that are producing that live event and have the intellectual property to that, they can set prices that are much higher. So we've seen this enormous growth in media rights for all of the major sports leagues, and we now have the ability to participate in all of the North American sports leagues as well as sports leagues around the world. What was the challenge was being right about the theme doesn't do any good if you can't find a way to invest in it. So, most people think of sports teams, they think very, very few people get to invest in those. Mm-hmm. And they're right. Very few people can. In 2019, the rules were changed to allow private equity firms like us and our partners that we work with to be able to actually buy into multiple sports teams in the same league. So Major League Baseball was the first, and then hockey, and then basketball, and then soccer, and most recently the NFL. So those rule changes now allow very select and very hand-picked private equity firms to be able to invest in those sports teams and to be shoulder to shoulder with the owners of those teams.
Taken Americans' favorite pastime to another level.
Absolutely.
You really have. So in what you're doing, because these assets are not traded publicly, there's a terrific amount of due diligence. Mm-hmm. So can you speak to the due diligence process?
For our firm, we've always kept it really, really simple as to where we start, and it gets more complex from there. But our adage has always been the same. If we can live with the worst case scenario, the upside will take care of itself. So we spend an inordinate amount of time focused on what's the worst case. How does this blow up in our face? How does somebody do us wrong? That's the nice way to say that. How does somebody, just get something completely, off in their modeling, in their predictions, in the way that they go about doing things? What could really, really not happen that we thought was going to happen, or what could happen that we didn't think was going to happen? And once we build that worst case scenario, if we can live with that, then we'll figure out how we go about picking the right specific investments or the right teams or the right partners. We're very, very focused on both the science of investing, which most everybody can do, and the art of investing, which some people can do.
And the art of investing is picking the ideal partner. Mm-hmm. How much work do you go to, and how do you know whether that's an ideal partner?
Past performance is no guarantee of future results. We know that. Everybody knows that. But past performance can be a good indicator of what's possible. So what we look for more than anything else is persistency. So a lot of people call, they want the best performance. Okay, I like really good performance, but what matters to me the most and our firm the most is the predictability of the performance, and that comes from persistency. If somebody is the best performer, then the worst performer, then the best performer and the worst performer, but on average they're pretty good, we have no interest. We're looking for somebody that has been persistent over time. And it's that focus on the worst case scenario, and it's the focus on persistency that has allowed us to achieve what I consider to be the statistic that I'm most proud of as a business. In the last almost quarter of a century that we've been investing capital in the private markets, we have made money or have unrealized gains on 95% of all of the investments we've ever made in the private markets. There's people that have made more, but for us, the predictability of it and the focus on the downside has enabled us to have a batting average that I'd put up against anybody.
That is really helpful. And I think that much of it applies to active management on the public side as well, which may have been lost a little bit in the indexing craze, but those are similar attributes.
They are indeed. And one of the things that every single organization should be able to show is how, public, private, whatever, how is it that they really added the value that they did? Are they just a closet beta shop, just market, index, just don't call themselves that?
Yep.
Or are they really adding value? Do they have conviction? Do they have the ability to identify mispricing and then to be able to harvest the benefit from that mispricing? Or in the case of the private markets, many of the times it is how much value can they add in actually improving a company once they've invested in it or acquired it. That's a huge difference between effectively one firm and another firm.
That management team is so critical, isn't it?
It
and
is.
Leadership in that group.
Well, it's something to where I think anyone who's ever been involved in sports or arts or anything else, you can have the absolute best talent, but without the right coaches involved, it's probably going to be tough to be persistent and consistent in performance or victory.
It takes a village.
That's correct. And
Yep.
It's really important to understand how all those pieces fit
Right.
together.
I thought when I asked about thematic investing and you brought it up, you'd immediately go to AI. You did not. Are you integrating that? And no one's figured out exactly how to make money on it. How do you view artificial intelligence?
As I'll answer it from the firm's perspective and then also from an investment's perspective.
Great.
So from a firm's perspective, we're all in on AI. We actually, a year and a half ago now, it's hard to believe it's been that long, but we went into a 5-year partnership with a company called Palantir, which is a publicly traded company that does enormously interesting applications to overlay AI on every aspect of our business to help us be better in in every single area of our firm. We have the ability to improve it using artificial intelligence. We challenge our team every single day. How can we use AI better or machine learning to do better? Our goal is to not just be efficient, but also to be effective. Efficiency is good, but not if it's not effective. So I explain it to people this way. AI will not replace people, but people who use AI will replace people. And people must find a way to understand it. I'll brag on my mother-in-law. She is 93 years old. And 2 weeks ago, she went to Lisa, my wife, and I, and she said, I hear you talk about this thing, ChatGPT, all the time, which we are early investors in ChatGPT alongside Khosla Ventures, one of our partners. We were very early in the company. And so we talked about it for 5 years. And she said, I hear it all the time. I want to use it. And she's primarily a phone user, great iPhone user. We installed ChatGPT on her phone, and she uses it every single day. So everybody can learn it, and it can be applied to practical aspects of our life and also to be able to utilize it in our business. From an investment standpoint, we were very early movers because we have great relationships with firms like Khosla or Peter Thiel and Founders Fund and so many of the other Silicon Valley firms that we partner with to be able to get exposure. So both when it comes to AI itself, machine learning, part of it, but also with robotics. We're very early investors in a company called Figure AI, which if somebody has not watched the robot who can tell the difference between a plate and an apple, and to be able to actually put together a BMW, which is happening right now
Fascinating.
at a plant in South Carolina. And oh, by the way, for everybody out there, the robots are real. They are very capable, and they're only going to get better. They're driven by AI. In the case of Figure AI, it uses OpenAI's technology to be able to talk back and forth to you and to take, would you pick up this cup? And what would happen if I turned it over? And they would say, well, the water would pour out and it would make a mess. Very, very common sense for a human being. Most people don't think of robots being able to do that. They can, and they're going to get better.
Yeah, it's amazing. And I think whether it's an investor or individuals, we need to challenge ourselves to be just a little bit better than we were yesterday. Every day, it's moving quickly.
That's right.
So I'm excited to hear.
And the thing I will say is AI, I'll give a little bit of caution to the audience because of the fact that anytime you have this seismic shift, just like we saw when the internet was a thing, and all of a sudden 1996 to 1999, you can end up with some really bad actors that are out there that are going to say they have the next best thing in AI, and it's going to make $1 billion for everybody that's involved. And unfortunately, a lot of it's just not real. So the buyer beware statement is very true. It takes investing with people that know how to vet the technology, know how to vet the team, like we talked about a minute ago, and not just chase whatever happens to be available. We turn down 98% of every investment that we look at. We look at 1,500 investments a year. We know there are going to be things that we miss that will be great, but we also know that we must be able to live with the worst case, and we must really believe there's persistency and predictability in the results. Otherwise, we're not going to do it. Investors don't just invest in what you can invest in what you should.
And frankly, a lot of these major shifts are led by private companies. The entrepreneurialism in America and that innovative spirit. And so it's interesting for people to be taking a look at that.
It's funny because I laugh because of the fact that most people are like, oh, the public companies do most of the innovation. That is so far from true, it's not even funny. The big companies, they buy the innovation that's been created by entrepreneurs.
Great point.
That's the venture capital world. You think about Netflix, it was a private company. You think about Google, it was a private company. You think about Amazon, it was a private company. They developed these incredible business models. Then they went public. And now, many times, they buy smaller firms to bolt on new types of technology. Apple Computer, all of them are the same way. They go out and they let somebody prove the concept, and then they buy it from them because that's a more efficient way to use their capital than being in the laboratory trying to figure something out that may or may not work.
And that rate of change is accelerated so that it might not be 15 years down, 10, 15 or 20 years down the line. It might be 3 to 5 on some of these.
There's an old saying that we tend to overestimate what's going to happen in the short run and underestimate what's going to happen in the long run. You think about autonomous driving, 4 years ago, everybody was saying, by 2025, nobody was going to be driving a car. That was really not a reality. It's beginning to become more of a reality today, and it's going to accelerate. And so it tends to go like this, and then it accelerates at a very fast rate. For those who are familiar with Moore's law, computers double in power basically every couple of years. That's where we are. AI will be just like that. There will be things, robotics will be just like that. It won't do as much in the very short run, but it will literally change our world in a decade.
Thank you. That's great. I've been thinking about leadership, and you've served in leadership positions. You were on the Greater Houston Partnership Executive Committee. You were in a leadership position in Prudential, Oppenheimer, Payne Weber, and there must have been along the way someone who either gave you the best advice or the worst advice. Does anything harken in your life experience?
So the first is the easiest for me because that's Tony Robbins. So I started following Tony in 1991 when I was literally 21 years old, 22 years old. And I really, for my entire adult life, have followed basically what he has taught. And from a business perspective and just from a personal standpoint, but also from a leadership perspective. There are so many Tonyisms that I use throughout the day. I also coached high school football for 4 years. in addition to running the business, etc. And I learned as much from some of those fantastic football coaches about leadership that applies every bit in our business today as it did on a football field when I was coaching. So there are so many adages that we all think about, that we know about, that as long as we apply them in a consistent way and everybody on the team understands what they are, then they're going to be successful. We really follow that as a business. We have a few things that we say them very, very often. We make sure everybody understands what they mean, and then we try to do our best to live up to those expectations, what we refer to as the CAZ promises, every single day. We all fail every day, but we strive to accomplish those things every day. The advice on the negative side are things where you learn more from somebody's bad advice or watching them, make a mistake. Those are very, very valuable. There's no, specific aha moment, if you will, other than, there was a situation to where I was watching a train wreck happen, if you will, from a little bit of a distance. And it made me think about the old proverb, which is, he who chases two rabbits catches none. And how they were just basically pulling themselves in so many different directions, they were good at nothing. And that was something that was very, I think, informative to me as I've developed over my career.
Great. If one were to pick up a book that might be a great book about private investing, or just a book that you find has great life lessons, do you have a favorite in your repertoire?
We have a whole list of books that we require every new person on our team to read.
Really?
So we have what we refer to as CAZ University. When somebody joins our firm, they are not allowed to work for 30 days. Some 3 weeks, some 5 weeks, depending on the role. They literally are a student for 3 to 5 weeks. As part of that, they're asked, required, expected to read all of these books and actually write a summary of those. And we can tell if they use AI. So it's really easy. But so we asked them to write a summary of that book, of what it meant to them and their role, of how they think that it can be applied. So naturally, on the world of private investing, I'm totally biased, but The Holy Grail of Investing was written to be able to be a primer. We have a lot of investment advisors that give it to their client and say, read this, and then we're going to have a conversation about it in a couple of weeks. Let me know when you finish. Because the first half of the book is all about literally what is a GP stake, where you're owning a private asset management firm. Why would you want to own a professional sports team? What is going on in the world of energy? What is private credit? What is buyout? What is growth capital? Why enterprise software? All of these things that we do in the front part of the book are purely educational and informative, and they were designed to be understandable for somebody who knows nothing about private equity, as well as the professional who knows a lot about what's going on in the private markets. The back half of the book is an interview with 13 of the top managers of firms that literally invest in each of these spaces that we talked about. Household names, true icons of, not the firm icon we talked about earlier, but icons of the investing universe. We interviewed them, and it wasn't about their strategy. It was about what made them successful. What is it that truly differentiates them in their leadership style, their journey, what they've learned from the role that they have? It's much more on who they are as a person and how people can learn from that when they're managing whatever business it is that they're managing, or the family that they're managing, or the charity that they're managing as well. Other books that we have as required reading would be, I think, one of the most classics of all time, The 7 Habits of Highly Effective People.
Okay.
Good to Great is another one. The 4 Disciplines of Execution is one that not as many people have heard about. That changed our business. It really did. 4 Disciplines of Execution. It's written by Covey's actual son, by his son. And it's a really, really good book. There's a whole lot of other books that we have that are more market-centric to what we do, that I think for the audience, though, if they read nothing more than the 4 Disciplines of Execution, Good to Great, 7 Habits of Highly Effective People, and The Holy Grail of Investing, that is a really, really good place to start. And then what you do is, in any book selling service, you go online and say, okay, when people read this book, what else did they read? And I think that's a great way to get ideas that if, I try to read every single day something that's not market related, that is purely going to help me grow as a person, to what you said earlier. And that to me is a huge part of my regimen, and I encourage for everybody else as well.
That is meaningful advice. We really appreciate it. And we are so pleased that you came today. I think our audience is going to get lots of great information. So thank you for your time, Christopher. It's a pleasure.
No, thank you for having me. It was a lot of fun.
Yeah.